a white-knuckle week for investors, many pointing to rising interest rates as the culprit behind a huge sell-off. The Dow Jones Industrial Average gave up 5.25% in 2 days. The S&P 500 down 2% in 2 days. The Nasdaq giving up 2% in just 2 days this week. President Trump breaking tradition, calling out Chairman Powell on several occasions.
The problem, in my opinion, is Treasuries and the Fed. The Fed is going loco, and there's no reason for them to do it, and I'm not happy about it.
I think the Fed is making a mistake. They're so tight. I think the Fed has gone crazy.
I'm paying interest at a high rate because of our Fed, and I'd like our Fed not to be so aggressive because I think they're making a big mistake.
It's a correction that I think is caused by the Federal Reserve with interest rates. I think the Fed is out of control. I think what they're doing is wrong.
Wow. Well, the Federal Reserve did raise interest rates 3 times so far this year. Joining me right now to talk about that and a lot more is BlackRock's Rieder. Rick oversees $1.9 trillion in bond assets and the world's largest money manager, BlackRock. BlackRock overall currently more than $6 trillion in assets under management at BlackRock. And Rick, it is great to have you on the program.
Thanks, Rick. Great to be here.
Thank you so much for joining us. So, wow, what a week it was. Well, assess the situation for us. What do you think went on this week?
It was, I don't know, in years, it was the most volatile week. It was the most tumultuous. By the way, not a lot of liquidity. I mean, the markets were gapping, all markets, equities, rates, were gapping on not a lot of volume. And that's, trying to figure out what is actually driving it. What's driving it is people pulling away. And, people, I don't think, recognize when you drain liquidity from the system, when the Fed ends QE and the ECB ends QE and the Treasury actually issues a lot of debt, you drain liquidity from the system. You now have a system that's more volatile. And so when you get selling, it almost creates more selling because there's not the liquidity in the world that there was a year ago, 2 years ago, when you were putting tremendous liquidity in the system. So, it started with the rates moving higher and, hitting the 3.25. And markets are always funny about, the round numbers. 3 was the big, if we ever hit 3, now it's 3.25. And, we bottomed, and interestingly, on Monday, around midday Monday, when right at 3.25, and now we've come off of that. So, I think we'll be a bit more stable going forward, but it was a wild week.
It really was, and volatility picked up, volume picked up as well. There's a feeling out there that there's been a shift in allocation. People are getting out of stocks, going into bonds. Did you do that?
So, not so much within the portfolios in terms of getting out of stocks.
Is that happening, though?
I would say there's definitely some reduction in equities. The thing that's pretty amazing is what's happening now. We see in our flows, what you see in the industry flows, and these shift over time, but less money going into stocks and bonds, and so so that pauses, and that's a bit of that liquidity dynamic. But what people are doing, there's a big asset allocation shift that's happening. The 2-year Treasury earns almost 3%. You're seeing more and more money coming into short-dated. I want safe assets. I want assets that I can't lose money in. And particularly after the equity market has run up so much, the bond market is experiencing higher rates. So what do? Gosh, give me 3%, and I'll feel good at night. I'll sleep at night, and that's a big shift that's happening.
Well, that's the thing. I mean, if I can get 3% in a 2-year, and I know that I have safety of Treasury, the U.S. government, why would I pick stocks which may carry more risk, and then I could lose money?
So I think when you think about it on a portfolio concept, and what we advise people, and from a portfolio point of view, so gosh, I used to own a lot of long-dated treasuries. Maybe I own 10-year treasuries, 30-year treasuries, because they helped my risk. But now the yield curve is flattened. Short-end interest rates are higher. I don't need those long-end rates anymore. I'll get the short end. And by the way, equities, I would argue after this, particularly after this down move, if you take the free cash flow multiples in the equity market, it's actually U.S. equities. Earnings are still very good. Companies are buying back historic amounts of stock. So maybe in a portfolio, I'll own some of the front end of the yield curve, and then I'll own some equities for upside appreciation.